The largest bankruptcy in American history happened while most people were asleep. Lehman Brothers, 158 years old, survivor of the Civil War, 2 World Wars, and the Great Depression, filed for Chapter 11, bankruptcy protection in the early morning hours of September 15, 2008. $639 billion in assets, $613 billion in debt. The 4th largest investment bank in the United States simply ceased to exist. But here's what makes Lehman different from every other financial collapse. It didn't have to happen. This wasn't an inevitable failure. This was a choice. Treasury Secretary Henry Paulson and Federal Reserve Chairman Bernanke deliberately refused to bail out Lehman. They had saved Bear Stearns 6 months earlier with $29 billion in government guarantees. They would save AIG days later with $182 billion. But Lehman would be allowed to fail as a lesson to Wall Street about risk and moral hazard. The lesson backfired catastrophically. By Tuesday morning, the global financial system was in free fall. Credit markets froze. Banks stopped lending to each other. The commercial paper market, the invisible plumbing that funds day-to-day business operations for corporations worldwide, seized up completely. Money market funds broke the buck, triggering panic withdrawals. Stock markets crashed. The contagion was instant and total. Within days, the government reversed course. AIG received an $85 billion bailout, then $182 billion total eventually. TARP, the Troubled Asset Relief Program, was rushed through Congress authorizing $700 billion to stabilize the financial system. The government bailout critics had demanded they avoid with Lehman became unavoidable everywhere else. Lehman's bankruptcy didn't prevent bailouts. It made them larger and more desperate. This is the story of the weekend that changed everything. How Lehman Brothers, a firm that survived the Civil War, 2 World Wars, and the Great Depression, collapsed in 2008. How government officials chose to let it fail as a message to markets, and how that message backfired so spectacularly it nearly destroyed the global economy. Understanding Lehman matters because it proved that some institutions are too interconnected to fail, regardless of moral hazard concerns. The decision to let Lehman go bankrupt is now considered one of the greatest policy mistakes in financial history. The lessons from that weekend shaped every crisis response since, including the immediate bailouts that followed and the trillion-dollar interventions during COVID. Lehman taught policymakers that when systemic institutions fail, ideology and principles collapse alongside them. Lehman Brothers was founded in 1850 by 3 brothers, Henry, Emanuel, and Mayer Lehman, German Jewish immigrants who started as cotton merchants in Alabama. Through the Civil War, Reconstruction, industrialization, and the rise of American finance, Lehman grew into one of Wall Street's most prestigious firms. By 2008, Lehman was the 4th largest investment bank in the United States behind Goldman Sachs, Morgan Stanley, and Merrill Lynch. The firm's business model was classic investment banking, underwriting securities, trading bonds and stocks, advising on mergers and acquisitions, managing assets for wealthy clients. But by the 2000s, Lehman had shifted aggressively into real estate and mortgage-backed securities. This would prove fatal. The housing bubble of the early 2000s was intoxicating. Home prices rose relentlessly. Mortgages were issued to anyone with a pulse. Subprime lending, giving mortgages to borrowers with terrible credit, exploded. Banks packaged these mortgages into securities called MBS and CDOs, sold them to investors worldwide, and claimed they were safe because diversification spread the risk. It was nonsense. When home prices stopped rising and borrowers defaulted, the securities built on subprime mortgages became toxic. Lehman held enormous exposure to subprime mortgages and commercial real estate. By 2007, Lehman had over $50 billion in real estate assets on its books. When the housing market turned in 2006 to 2007, those assets plummeted in value. But Lehman didn't disclose the losses fully. Instead, the firm used accounting tricks to hide the damage and continued operating as if everything was fine. The warning signs appeared early 2008. Bear Stearns, another major investment bank heavily exposed to subprime, collapsed in March 2008. Bear's failure was sudden and terrifying. On Thursday, March 13th, Bear was solvent. By Friday, it faced a bank run. By Sunday, the Federal Reserve organized an emergency sale to J.P. Morgan Chase for $2 per share. Bear had traded at $170 per share a year earlier. The government provided $29 billion in guarantees to make the deal happen. Bear was saved from bankruptcy through a forced sale and government support. Lehman watched Bear's collapse and knew it could be next. Lehman's stock price fell sharply in March 2008 alongside Bear's failure. But Lehman's management, particularly CEO Dick Fuld, insisted the firm was different, stronger, better managed. Lehman would survive. They weren't just delusional, they were actively hiding the truth. Lehman employed an accounting gimmick called Repo 105 to temporarily move assets off its balance sheet at quarter end, making the firm appear less leveraged than it actually was. The mechanism was simple but fraudulent. Lehman would sell securities to another party with an agreement to repurchase them days later, a repurchase agreement or repo. By structuring these as sales rather than financing, Lehman could remove up to $50 billion from its balance sheet right before reporting periods, then bring the assets back after filing statements with regulators and investors. This made Lehman's leverage ratios look healthier than reality. In 2008, Lehman used Repo 105 to move $50 billion in assets off balance sheet before each quarterly report. After the report was filed, the assets came back. The true leverage was hidden. When investigators examined Lehman's books after bankruptcy, they found internal emails showing executives knew Repo 105 was misleading and used it deliberately to deceive investors and regulators about the firm's financial condition. By summer 2008, Lehman's subprime exposure and real estate holdings were massive liabilities despite the accounting tricks. The firm reported a second quarter loss of $2.8 billion in June 2008, the first loss in Lehman's history as a public company. Even with Repo 105 hiding tens of billions in assets, Lehman couldn't hide the losses anymore. Confidence evaporated. Lehman's stock, which traded above $60 in early 2008, fell to single digits by September. Clients withdrew funds, counterparties demanded more collateral, short sellers circled aggressively, betting Lehman would fail. Fuld scrambled for solutions. Lehman tried to raise capital. The firm sought buyers. Korea Development Bank explored purchasing a stake in Lehman in August 2008, but talks collapsed. Fuld approached the government for support, but Treasury Secretary Paulson, himself a former Goldman Sachs CEO, insisted there would be no government bailout for Lehman. Markets needed to accept responsibility for risk. Moral hazard had to be addressed. Bear Stearns had received government support, and critics argued this encouraged recklessness. Paulson vowed Lehman would be different. The market would find a private solution or Lehman would fail. No taxpayer money. This was a catastrophic miscalculation. Paulson and Bernanke believed Lehman's failure could be contained. They thought months since Bear Stearns had given markets time to prepare. They assumed Lehman's counterparties had hedged their exposure and reduced risk. They were completely wrong. The final weekend began Friday, September 12, 2008. Lehman's stock closed at $3.65, down 45% for the day. The firm was out of options. Without a buyer or government support, bankruptcy was inevitable by Monday. Paulson summoned Wall Street's CEOs to the New York Federal Reserve Building for an emergency weekend meeting. The message: find a private solution to save Lehman or prepare for its failure. No government money would be provided. Two potential buyers emerged: Bank of America and Barclays, the British bank. Both conducted due diligence through the weekend, examining Lehman's books to assess whether a purchase was viable. What they found was horrific. Lehman's assets were worth far less than claimed. The accounting had hidden massive losses. The liabilities were staggering. Any buyer would need tens of billions in government support to absorb Lehman's toxic assets. Bank of America walked away Sunday morning. Instead, BOA announced it would purchase Merrill Lynch, another troubled investment bank, for $50 billion. Merrill had massive subprime exposure too and faced imminent collapse. Bank of America chose Merrill over Lehman because Merrill's problems seemed more manageable, and because the government hinted it would support a Merrill acquisition. Lehman was left without a buyer. Barclays remained interested but faced a critical problem. British regulators. The UK's Financial Services Authority refused to approve a Barclays acquisition of Lehman without a shareholder vote, which couldn't happen over a weekend. And British regulators demanded guarantees that Barclays wouldn't be exposed to Lehman's liabilities during the transition period before shareholder approval. The U.S. government refused to provide those guarantees. Without government backstop, Barclays walked away Sunday afternoon. Paulson and Bernanke made their final decision Sunday evening. Lehman would file for bankruptcy Monday morning. No government rescue. The firm would fail. Markets would have to absorb the consequences. It was time, they believed, to draw a line. Not every failing institution could be saved. Lehman would be the example. At 1:45 a.m. Monday, September 15th, Lehman Brothers filed for Chapter 11 bankruptcy protection. The filing listed $639 billion in assets and $613 billion in liabilities. It was the largest bankruptcy in U.S. history, dwarfing Enron, WorldCom, and every other corporate failure. 158 years of operation ended. 25,000 employees learned Monday morning they no longer had jobs. Lehman was dead. The market reaction was immediate panic. Lehman's bankruptcy triggered margin calls across the financial system. Every counterparty that had traded with Lehman now faced billions in potential losses. Derivatives contracts were unwound chaotically. Collateral was seized. The scramble to exit Lehman exposure crashed markets globally. The Reserve Primary Fund, a large money market fund, announced Monday afternoon that it had broken the buck. Money market funds are supposed to maintain a stable $1 per share value. They're considered ultra-safe. Breaking the buck means the fund's value fell below $1 per share. Reserve Primary held $785 million in Lehman commercial paper that became worthless overnight. The fund's value dropped to 97 cents per share. Investors panicked. Money market fund redemptions exploded. If one fund could break the buck, others might too. Investors pulled money from money market funds en masse. Over $300 billion fled in days. Funds that had been stable for decades faced redemption requests they couldn't meet. They sold assets frantically, commercial paper, treasury bills, corporate debt, at whatever price they could get. The forced selling pushed asset prices down further, creating losses for other funds, triggering more redemptions. A doom loop accelerated. Money market funds provide critical short-term financing to corporations through commercial paper. Short-term unsecured debt companies issue to fund operations. Normally, when commercial paper matures, companies issue new paper to replace it. It's called rolling over debt. Businesses rely on this. They use commercial paper to make payroll, buy inventory, cover expenses while waiting for customer payments. When funds face redemptions, they stop buying new commercial paper. They don't roll over maturing paper. The market froze. Corporations that had funded operations through commercial paper for years suddenly couldn't issue new debt. Blue-chip companies with perfect credit histories faced funding crises. General Electric, one of America's largest industrial conglomerates, struggled to issue commercial paper. If GE couldn't access short-term funding, who could? The answer, almost nobody. The commercial paper market essentially shut down. Companies hoarded cash, cut spending, prepared for the worst. The invisible plumbing of the financial system was clogging. Credit markets seized entirely. LIBOR, the rate banks charge each other for short-term loans, spiked. The TED spread, the difference between interbank lending rates and safe Treasury rates, exploded to levels not seen since the Great Depression. Banks stopped trusting each other. If Lehman could fail overnight, who else was next? Lending stopped. Credit froze. Tuesday, September 16th, the Dow fell 504 points, the worst day since September 11, 2001. But the real crisis was invisible to most people, in the plumbing, in the credit markets, in the interbank lending that keeps the financial system functioning. That plumbing was broken. By Wednesday, AIG, American International Group, the largest insurance company in the world, faced collapse. AIG had sold billions in credit default swaps on mortgage-backed securities. When those securities failed, AIG owed enormous payouts it couldn't cover. Lehman's bankruptcy accelerated the crisis. AIG's credit rating was downgraded, triggering collateral calls AIG couldn't meet. The firm faced bankruptcy within hours. This time, Paulson and Bernanke didn't hesitate. AIG was too interconnected. Its failure would trigger a cascade that made Lehman look trivial. On Tuesday evening, the Federal Reserve announced an $85 billion loan to AIG in exchange for 79.9% government ownership. AIG was nationalized. The bailout critics had opposed with Lehman became unavoidable with AIG. The total AIG rescue eventually reached $182 billion. The contradiction was stark. Lehman failed to teach markets a lesson about moral hazard. AIG was rescued because its failure would destroy the system. The distinction Paulson tried to draw, save some, let others fail, collapsed immediately. Markets learned the wrong lesson. If you're big enough and interconnected enough, you'll be saved. Lehman wasn't too big to fail. AIG was. The moral hazard Paulson feared with Lehman was cemented with AIG. When the London gold pool closed in March 1968, there was no warning. Investors woke up and the market was locked. No gold available, no conversion. Done. We created the 7-stage collapse survival guide so you never get trapped when the window closes. It shows you exactly when to move your wealth into assets that survive collapse. Before banks freeze, before governments confiscate, before inflation devours your savings. While you can still act, access it at https://pay.hotmart.com/B1033628117E. The week after Lehman's bankruptcy was financial Armageddon. On Thursday, September 18th, Paulson and Bernanke met with congressional leaders to request emergency authority to stabilize the system. Paulson reportedly told them, "If we don't act, we won't have an economy by Monday." Congress initially balked but eventually passed TARP, the Troubled Asset Relief Program, authorizing $700 billion to purchase toxic assets and inject capital into banks. The program Paulson said wouldn't be needed for Lehman became the only thing preventing total collapse. Banks around the world failed or required bailouts. In the UK, HBOS was emergency merged with Lloyds. Royal Bank of Scotland required a government rescue. In Europe, Fortis, Dexia, and Hypo Real Estate needed bailouts. Iceland's entire banking system collapsed and the country nearly went bankrupt. The contagion was global and instant. Lehman's failure proved that in interconnected financial markets, one institution's bankruptcy triggers cascading failures everywhere. The stock market crashed. The S&P 500 fell over 40% from its 2007 peak to March 2009. Trillions in wealth evaporated. Retirement accounts were decimated. The real economy followed. Unemployment spiked from 5% in 2008 to 10% by 2009. GDP contracted. The Great Recession officially began. Millions lost homes, jobs, and savings. The financial crisis became an economic catastrophe. For Lehman's shareholders and employees, the collapse was total. Lehman stock went to zero. Equity holders were wiped out. Employees lost jobs, and many lost retirement savings invested in Lehman stock. The bankruptcy took years to unwind. Creditors recovered pennies on the dollar. The firm that had survived 158 years was liquidated for parts. Dick Fuld, Lehman's CEO, became a symbol of Wall Street hubris. He had refused to raise capital earlier when it might have saved the firm. He rejected offers to sell Lehman at higher prices months before the collapse. He insisted Lehman was stronger than it was. His compensation over the years totaled nearly $500 million. While Lehman collapsed, Fuld walked away wealthy. He testified before Congress and faced public fury but never faced criminal charges. The crisis produced no major prosecutions of Wall Street executives. The system failed, but accountability didn't follow. The policy response to Lehman shaped everything since. The Federal Reserve slashed interest rates to zero and kept them there for years. Quantitative easing, the Fed buying trillions in bonds to inject liquidity, became standard. Government intervention in markets became normalized. The too big to fail problem worsened. Banks that were bailed out grew larger. Mergers during the crisis created even bigger institutions. J.P. Morgan absorbed Bear Stearns and Washington Mutual. Bank of America took Merrill Lynch. Wells Fargo acquired Wachovia. The largest banks became more systemically important, not less. Dodd-Frank regulations passed in 2010 attempted to prevent another crisis. Stress tests, higher capital requirements, resolution authority for failing banks. But the fundamental problem remained. Massive institutions whose failure would crater the economy cannot be allowed to fail. Lehman proved it. The government will intervene to prevent systemic collapse, which creates moral hazard. Banks know they'll be rescued, so risk-taking continues. Lehman also revealed the danger of ideology overruling pragmatism in crisis. Paulson's decision to let Lehman fail was driven by principle. Teach markets about risk, avoid moral hazard, force discipline. These are valid concerns, but applying them rigidly during a systemic crisis was catastrophic. Lehman's interconnectedness meant its failure triggered contagion that forced even larger interventions immediately afterward. The lesson isn't that principles don't matter, it's that during systemic crises, preventing collapse takes priority. Morality and discipline can wait until the system isn't on fire. The contrast with Bear Stearns is instructive. Bear failed in March 2008 and was rescued through a forced sale to JP Morgan with government guarantees. 6 months later, Lehman faced the same situation but was allowed to fail. The difference wasn't the firm's importance or interconnectedness. Lehman was actually larger and more interconnected than Bear. The difference was political. By September, Paulson faced intense criticism for the Bear bailout. He wanted to prove the government wouldn't rescue everyone. Lehman became the sacrificial example. The experiment failed disastrously. For investors, Lehman demonstrated that even venerable institutions can collapse overnight. Lehman survived the Civil War. It survived the Great Depression. It was one of Wall Street's most respected names. And it went to zero in months. The assumption that too big to fail protects institutions is backwards. Lehman was big. It failed anyway. What protects institutions is government willingness to intervene. When that willingness disappears, even briefly, size doesn't matter. Institutions collapse. For the broader economy, Lehman showed how financial system fragility creates real economic devastation. The bankruptcy didn't just hurt Wall Street, it destroyed jobs, savings, and livelihoods for millions who never traded a derivative or worked in finance. When credit markets freeze, businesses can't get loans. When businesses can't get loans, they cut workers. When workers lose jobs, they stop spending. The contraction spirals. Lehman's bankruptcy triggered a chain reaction that took years to reverse. The timing of Lehman's failure was particularly catastrophic. It occurred weeks before a presidential election. The outgoing Bush administration was politically weak. Congress was polarized. The incoming Obama administration wouldn't take office until January 2009. The crisis hit during a leadership vacuum, delaying response. By the time TARP passed in early October, 3 weeks after Lehman failed, the damage was massive. Earlier intervention might have contained the crisis. Instead, Lehman's failure was allowed to metastasize. September 15, 2008 is now taught in business schools as a case study in policy failure. The decision to let Lehman fail is dissected endlessly. Could it have been saved? Should it have been saved? What would have happened if Barclays or Bank of America had acquired it with government support? The counterfactuals are debated, but the outcome is clear. Letting Lehman fail was a catastrophic mistake that nearly destroyed the global financial system. The irony is that Lehman's failure didn't prevent bailouts or teach the lesson Paulson intended. Instead, it proved that systemic institutions must be rescued, making future bailouts inevitable and larger. The government spent far more saving the system after Lehman failed than it would have spent saving Lehman directly. AIG alone cost $182 billion, more than enough to have rescued Lehman multiple times over. For those who worked at Lehman, September 15, 2008 is a personal tragedy. 25,000 people lost their jobs overnight. Many lost retirement savings, careers ended. The firm's culture, built over generations, was destroyed in hours. Lehman employees were told not to return to the office. Security escorted them out carrying boxes of personal belongings. The building that had housed Lehman Brothers for decades was emptied and eventually sold. The physical presence of the firm vanished as quickly as its balance sheet. For Wall Street, Lehman was a near-death experience. The crisis revealed how interconnected and fragile the system had become. Derivatives, leverage, and off-balance sheet exposure created a web where one firm's failure triggered cascading collapse everywhere. The 2008 crisis wasn't caused by Lehman's bankruptcy. The crisis was building for years through reckless lending, inadequate regulation, and over-leveraged institutions. But Lehman's failure was the catalyst that turned a brewing crisis into a catastrophe. The weekend of September 13th to 14th, 2008 was the last moment intervention might have prevented total meltdown. Paulson and Bernanke chose to let markets solve the problem. Markets couldn't. By Monday morning, the decision was irreversible. Lehman filed for bankruptcy at 1:45 a.m. By Tuesday, the system was collapsing. By Wednesday, the government was frantically bailing out institutions it had refused to save days earlier. The lesson was brutal and expensive. Ideology doesn't survive contact with systemic crisis. This is decoded economics. Subscribe to see the collapse before it happens.